Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's a senior vice president and derivatives portfolio manager at PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, Victor.
Thank you, Jim. Good to be back with you.
Before we start picking around individual things, what do you think of what's happened so far here to the middle of the year?
Well, I write my weekly trading desk notes. That's what I call it, and I see people can see those on your HowStreet.com website as well as my own at Polar Futures Group. I guess my current theme for the past month or so has been that the irresistible force in the market that affects all market has been the aggressive repricing of people's expectation of where interest rates are going to go in the future. You go back to November of last year, the market was expecting that the Federal Reserve would be doing 3 interest rate increases. And they did 1 in December, but there's going to be another 2 in 2018. Fast forward to, let's say, June or so of this year, and the market was expecting at least 3, if not more, cuts from the Federal Reserve. So that's kind of the quick sketch as to this 180 that's happened in the market. But we've seen some huge moves in some of the markets that have been based on this thought that either we're going into a recession and or, the Fed is going to be aggressively putting liquidity into the system, monetary easing. So I think that has impacted a number of the markets that we can talk about individually. But my theme has been that maybe that really powerful force that ripped through markets for the past 8 months or so went too far, too fast, and we would get what I would call a reversion to the mean. In other words, some markets that had maybe got out over their skis were going to have a little bit of a setback. I mean, this irresistible force was manifest by a number of things. We had a huge rally in the bond market. We had a new all-time record amount of negative yielding bonds in the world. Back in the Brexit summer of 2016, I think the number was 12 trillion. I think we went north of 13.5 trillion dollars worth of negative yielding bonds. We had an inverted yield curve. And one of the things that really rings a bell for somebody like me was you saw these massive capital flows into bond funds of different kinds. Now, other than that, we saw the U.S. dollar generally weaker, gold prices, for instance, higher than the stock market higher. So, that's kind of been the big picture. We are now, in a way, in the summer doldrums. So, low volume, volatilities are quiet, and we're right into the heart of the second quarter earnings season, where all the companies would come out and report on how they've been doing and what they expect to do in the next little while. So the market may be a little susceptible here because it's thin to some event risks. And I'd say, just to wrap it up, the consensus call seems to be that we're likely headed into a recession, if not just a good business slowdown, and markets might price for that. Although when you look at the difference between stocks and bonds, you'd have to think the stock market's not getting the memo from the bond market with that story in mind.
We'll have more with Victor Adair right after the break.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Victor Adair. Victor, given that interest rate expectations are having an impact on all markets, what do you see happening with bonds?
Just to give you some perspective on that, go back to that summer of 2016. I call it the Brexit summer. And that's when interest rates hit, some people were calling it 5,000-year lows. I mean, we had real low levels. The 10-year U.S. Treasury at that time was 1.4%. And I believe that was the lowest ever that the U.S. Treasury bond traded at. From that period of time, from the summer of 2016 until November of last year, we had a very sharp rise in the yield of most bonds. The expectation was, and the reality was, that the central banks, particularly the Fed, were going to back away from monetary easing, cue this, cue that, and we're going to be, in the case of the Fed, paring back their balance sheet. In other words, tightening financial conditions, raising interest rates, and that drove the yield on the 10-year bond to about 3.25% by November last year. Since then, with what I've talked about, this expectation in the market that we're going to swing the other way now, we've had yields on the 10-year fall below 2%, and right now we're at about 2.1%. So I think that the bullish view going forward from here is that the Fed, which is got the Fed funds rate, call it at 2.5%, and that kind of anchors where the bond market can be if and when the Fed cuts rates as we go forward. That's going to make it easier for bond yields to fall. That's sort of the bullish call. And that would maybe happen on the back of certainly a business slowdown or recession or a lot of uncertainty in the markets, whatever. Not the least of which might be, the President of the United States yelling at the Federal Reserve to cut rates. So I think right now the expectation is the Fed's going to have a meeting 2 weeks from now at the end of July, and it's for sure they're going to cut rates by 0.25%, and there's even odds, I'd say about 30% odds, the way the market's priced, that they might cut 50%. So I think the market's probably, in my view, market's still a little bit optimistic here, if you could call looking for lower rates to be optimistic. I think they've got that priced a little bit too rich. That's my thought. I think we really had a tremendous rally in the bond market, and I think it got overdone, and so we're going to have some chop back and forth. Now, as a trader, believe me, I've got a point of view, and if it turns out the market says, hey, Victor, you're wrong, I'll take my lumps and go to the sidelines.
We'll have more with Victor Adair right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, the Dow and S&P 500 made all-time highs lately. Are they ignoring the message from the bond market?
Well, it's interesting. It's kind of in the short-term time frame. You think that if the stock market is falling, then maybe the bond market gets a bid because capital goes over to the safety of the bond market. But as I just mentioned, since the summer of 2016, the Brexit summer, interest rates have gone on the 10-year from roughly 1.4% all the way up to 3.25%. The S&P from that summer to where we are now is up about 44%. So in other words, the stock market was rising even though interest rates were rising. Now, to say we're up 43%, 44% from the Brexit summer, maybe overlooking, some pretty nasty breaks we had, like in January, February of 2018, the real nasty break in November, December of 2018, and even the 7% setback we had here in May, as we sold off hard in May and then got it all back and more in June. And, the pundits were talking about how this was the best June we've seen in 80 years or something like that, and kind of glossed over the fact that, May had been pretty rough, but, anyway, the market was, the commentators inclined to look at the bright side of things. We've had share buybacks, that are just an amazing force in the markets. Last summer, we saw the tech stocks were leading the parade, as it were. This time right now, it seems the defensive sectors are doing the heavy lifting. We've got a lot of non-confirmations. I mean, transports just got absolutely crushed here today, down 350 points or so. The small cap index, also a non-confirmation, as is the broad New York composite. So you have to remember these indices, they throw out the dogs and put in the stars. So the indices definitely outperform the broad market. Most people know that, but we've got very bullish sentiment right here, right now, I think, with the Fed, the Fed's expected to cut 2 weeks from now, and I think this would be a telltale sign. It's almost always when the Fed makes their first cut that the market jumps up, at least a couple of percent. And if we didn't do that this time, that might give you a heads up. I'm suspicious here, honestly, but I'm astonished at how strong the rally has been in the stock market, and I've definitely lost some money to take shots at it, thinking maybe it was going to roll over and it'll just come right back again. But I wouldn't be investing my grandma's money, in the market here, looking for it to keep going up. Certainly not very aggressively. So, yeah, I'm a little bearish.
Gold jumped over $100 during June and has sustained the gains so far. Where do you see it going from here?
Well, the gold market is often the flip side of the U.S. dollar. And the U.S. dollar was weak in June. Actually, the pivot date here was right around the end of May. Pivot date for a lot of things. I mean, the stock market, as I just said, fell throughout May and then had a great rally in June. So the stock market was rallying through June at the same time gold was going up. The strength in gold, I think, was greater than was warranted by the rather modest weakness in the U.S. dollar. We just talked about the interest rate market. Well, I'll tell you, that had a huge impact on gold. We saw nominal interest rates, but even more importantly, real interest rates. That's like interest rates after you subtract the inflation premium out of them, were really low. And that's very bullish for gold. We also had a couple of, we call it politely, geopolitical risk events. This is where it looked like Iran and America were going to bang heads in the Mideast there. And that gave gold a kick. And there's another thing. The gold market had been ignored for the past couple of years. I mean, we had that rally again into that summer of 2016, the Brexit summer. But then that just petered out and prices dropped down into new multi-year lows. So it was kind of a case of, who needs to buy gold when all you do is buy the stock market and it goes up all the time. So last fall, for the first time I can't remember, but it's got to be 10 years or more, the speculators in the futures markets were net short gold for the first time. I mean, that's how ignored it was. So we've seen a rush into gold here for the last 6 weeks or so. When that is the number of participants that have come in, the total open interest, the people that are more long than short, the net position there. We've had a very aggressive spec buying that looks very similar to the kind of a rush we had up in gold in the first half of 2016. I don't want to be short gold here, but I'd be nervous about buying it after it's had this very strong run. But again, having said that, the way I'm looking at the chart, I'm thinking maybe this sort of a wedge-shaped consolidation we've had here the past 3 or 4 weeks after that pop-up from the May lows, maybe just sort of a mid-range consolidation, and we could go higher in gold. So I'll be open-minded about that in terms of which way I play it. Right now, I don't have a position.
President Trump has said he wants a lower U.S. dollar because everybody else is manipulating their currency lower. Do you think he's going to get a lower U.S. greenback?
Well, boy, I mean, we used to call that currency wars, didn't we? I mean, maybe that was just last year's term. Yeah, the race to the bottom or something like that. Sure, in a mercantilist society, you figure if you can get your currency down, you're more competitive when it comes to trade. I see the Economist Big Mac Index just out here in the last few weeks showing that, at least in their terms, the U.S. dollar was overvalued against nearly every currency, especially Asian and emerging market currencies. So, there's something to that the U.S. dollar may be too rich. But in a way, then ask yourself, well, why is it too rich? And one of the thoughts that I've had for years is that capital does flow to the United States for business opportunities and for safety. If you look at the price charts of some of the major European banks, and you say to yourself, do I want to have all of my net worth denominated in the euro currency? I mean, I think the answer is no. Those banks look like they're really at risk. And you look at some of the other political problems that are in Europe, you would see why people might want to put some of their money into America. And it may be just the cleanest dirty shirt in the laundry hamper. There's that. But I think that is one of the reasons that the U.S. dollar, as well as it's got the seigniorage privilege of being the world's reserve currency, may be one of the reasons why it's deemed to be more expensive relative to other currencies. Now, very short term, I'm kind of inclined to think the U.S. dollar got weakened because of this overdone rush into pricing lower interest rates, and I'm predisposed, and I have some positions on to that effect, to think the U.S. dollar might get better from here.
Now, would the U.S. dollar go up again if we start to go into recession and other markets around the world really start to crash? Won't people flee back to what they consider to be a secure currency?
Short answer is absolutely yes. Picture it this way. If you have a bunch of concentric circles, at the center is safety, at the outside of the circles is risk. If you want to pick up more yield, you go out to risk. If you want more safety, you come back to the center. The center of the financial world is New York City, is America. So when you're feeling frisky, you go up and buy some securities, whatever the currency of, a country maybe you couldn't find on the map. When you want safety, you come back to America. That's both American capital that goes outside and foreigners who take money to America. So yes, if people get nervous, the U.S. dollar generally gets bid. Now, therefore, you can imagine, you could easily see a time when both the U.S. dollar and gold are going up in price.
I said on Canada Day, nothing says Canada Day like the long lineups to go into the U.S. to shop. And that might be because the Canadian dollar's gone up about 3 cents over the last 6 weeks or so. Is it going up because the U.S. dollar's going down, or are there other factors boosting the loonie?
Historically, I have said there are 3 things that are the main drivers of the Canadian dollar vis-a-vis the U.S. dollar. One is relative interest rates between Canada and the United States. The other is the relative strength or weakness of the U.S. dollar, we call it the big dollar, against all other currencies. And third is commodity prices. I mean, years ago when I would do a lot of conferences, I would put 2 charts up on the wall. One would be like a 10-year chart of a commodity index. The other would be of the Canadian dollar. And I'd say, from 20 feet back, tell me which chart is which. So this past, and I should interject. I mean, from time to time, there are other things, like recently what we call the trade war, or the trade tensions at least, between Canada and the United States, had some impact on the value of the Canadian dollar. But over time, it's those three things. And since late May, all three of those things were Canada bullish. In other words, on interest rates, the market was thinking the Canadian economy is much stronger than the U.S. economy. Therefore, and I'm keeping this simple, more sophisticated people, please forgive me for being so simple, but therefore, the Bank of Canada will not match the Federal Reserve rate cut for rate cut, and that caused the interest rate premium that you had in the United States to shrink relative to Canada, and that put a bid in the Canadian dollar. There's another thing. For the past 15 months, the speculators in the futures markets have always been short of the Canadian dollar. Well, they saw these things turning for the better as far as Canada is concerned, and they came into the market, not only covered their short positions, but went net long of the Canadian dollar, as I say, for the first time in 15 months or so. And their buying totaled about $5 to $6 billion notional value of Canadian dollars just in the futures market. So you had that positioning risk, and when you add those other fundamental bullish things to the positioning change, it's one of the reasons you got Canada to rally 3 cents. Now, I'm short Canada right here, and I may lose some money in the trade, but for the theme that I had, that this whole play of American interest rates are on their way to zero, sets up an opportunity, I was saying, to look to short bonds, short commodities, short stocks, and buy the U.S. dollar. So for me to maybe short Canada, or say it the other way around, buy the U.S. dollar against Canada after the Canadian dollar has rallied 3 cents and a whole bunch of speculators compiling in on the long side, makes sense. The last time we had this swing in Canadian dollar was in the beginning of October last year. Canadian dollar had run up, and of course then from October into the end of the year, Canadian dollar fell 5 cents as the U.S. stock market, had that tumble in November and December. But I'm looking for Canada to be a little overvalued here on the back of just a little bit too much enthusiasm for Canada.
Crude oil was as low as $51 in June, rallied up to $61 a few days ago. What's the story behind the price rise, and will it be sustained?
I always look at relationships in the markets and see if I can learn something, and certainly one of the things I've seen is that crude oil, or WTI, moves up and down, not in lockstep exactly, but in similar patterns to the stock market. I mean, say, from summer of last year into the fall of last year, crude oil and the stock market both went up. They both fell hard in November and December. Both rallied from the December lows up until April or so, and then crude oil rolled over. We've had the last month or so the stock market rising, say June and first half of July, crude oil up during that same period of time. So when the market's in a, call it bearish mood, they're going to be concerned about, say, lack of demand. Okay, if we're going to have a global slowdown, then demand's not going to be there. When the market wants to be bullish, then, the production cuts out of OPEC, the inability, because of sanctions, of the Iranians to export as much oil as they might otherwise, the inability of Venezuela because they get in their own way to be able to export, Libya, troubles over there. The market focuses on shortages, supply shortages. So, again, now, from a perspective, I'm short crude. I've been short crude here the past couple of days, kind of thinking that just the market had got a little overdone. Where do we go from here? I mean, I can concoct a bullish story or a bearish story. You got to be able to be open-minded, to where we may be sometime in the future. But I think crude may also, let's say, get caught up in, if in fact there is a reversion to the mean in a number of markets that moved because people got too bullish on falling interest rates, then I'm looking for crude to fall, and I'm short.
With all your years of experience, 40 years plus, what's the best advice you can get to people who want to be on the plus side of trading?
You know, if I was to cook it all down to one line, I'd say live to play another day. And boy, do I ever mean that. I mean, over the years, I got to see the trading performance of hundreds and hundreds of people because of not only my clients, but the clients of the brokers that, worked in the same company I did, worked me, whatever. And if there was a single common thing that people did that seemed to contribute to their losing money, it was they hate to take losses. You know, you kind of get drawn into an idea, whether or not somebody's, sold you on a sales pitch. I mean, for instance, in a sales pitch, let's say this one. Somebody says to you that the price of copper is going to go to the moon because of all the electric cars they're going to build are going to demand a huge amount of copper. And you go, gee, that makes sense. So you buy copper, and now copper starts to go down. Now what do you do? You know, it was a good story, but now you're in a war. So maybe you say, well, I'm in it for the long term. Well, that's probably the most common mistake. It's just, if you don't know before you get into a trade where you're going to get out of it, if you're wrong, then, you're in trouble. I mean, I think baseball players make pretty good money if they're right, get on base 30% of the time. With commodity trading, I think you want to do a little bit better than that, but it just can't possibly be a game of perfect. So live to play another day means just understand that you're going to have losing trades, and how you deal with those losing trades is probably way more important than however your method was that got you into the trade in the first place. So when I have pads here. When I put a trade on, I'm writing down where the market is at that time, why I'm doing the trade, where I'm going to get out if I'm wrong, what I think about it, and so on. And then I update that as time goes by. I mean, and I'm just, I look at my track record, and I definitely lose money on at least, if not more, than half of the trades I make. So, yeah, live to play another day. You got to know your time frame. Another aspect of living to play another day is sizing. You're going to take a position in the market. Well, how big? Relative to your capital, relative to your net worth, whatever. And then you also want to look at concentration risk. It's really easy if you have kind of a point of view. Let's say, for instance, you're bullish gold. So you go out and you buy several different gold mining companies. Well, it's the same trade. They're all the same trade. You may have concentrated your risk in one idea. If gold price doesn't go up, it's likely that none of those shares that you bought are going to go up as well. So, live to play another day. It's only a trade, and be prepared to be wrong and know what you're going to do about it before you get into the trade.
Victor, thank you so much for being on the show.
Jim, it's always a pleasure to talk to you. Honestly, I really appreciate it. Thanks.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.